Hi, I'm Sean Millington. In this, our fourth segment, we will look at common stocks. When you buy stocks or shares, you own a part of the company. Shares are initially sold by the company, usually by a prospectus, as we saw with bonds, and then traded among investors, usually on a stock exchange such as the Toronto or New York exchanges. When companies sell shares to investors, they give up some control to the new shareholders whose primary concern is profits. In return for this loss of control, the companies get money or capital they need to expand their business. If the venture prospers, the shareholders benefit from the growth in value of their original investment and perhaps the flow of dividends, which is a distribution of the company's earnings. If a company fails, the common shareholders may lose their entire investment. This was the situation in 2003 when Air Canada filed for bankruptcy protection. The shareholders were virtually wiped out as the creditors, which would include bondholders and the new investors, ended up owning the new airline. Shareholders have the right to vote on major policy decisions, such as changing the board of directors or whether to sell the company to outside buyers. As a general rule, one share represents one vote, although there are exceptions. Most shareholders vote by proxy, an absentee ballot they receive before the annual meeting. If you're fortunate to live in the city where the annual meeting is held, you have the option of attending the meeting and voting in person. A company's board of directors decides how large a dividend the company will pay, or whether it will pay one at all. In addition, they are responsible for hiring the chief executive officer of the company, and the CEO reports to the board. Usually only large, mature companies pay dividends. Shares in these companies are sometimes called blue chip companies, as shareholders usually buy these shares for the regular dividends. Typically, utility, pipeline, and communication companies, which often have their fees regulated, fall into this category, as their dividends are reasonably secure from year to year. Other companies that need to reinvest their profits to be able to continue to grow are called growth stocks. It is not always the smaller companies that retain all their earnings for growth. Apple, one of the largest companies in the world, up until very recently did not pay a dividend. Most people buy stocks to make money through capital gains, which is basically the profit from selling stock at a higher price than they paid for it. Unlike interest on bonds, dividends on common shares are not a contractual obligation. Dividends are paid at the discretion of the board of directors of the company, but usually once a company has started a dividend policy, they usually plan to maintain it for the long term. Companies may pay dividends monthly, quarterly, or annually. Quarterly is the most common. It is very important to note that dividends received from Canadian corporations have half the tax burden of an interest payment. Earning dividends is a great way to earn tax-efficient income. An announcement is made in advance of the payment date, with many of the larger companies placing advertisements in financial newspapers. The purpose of the interval between March 9th and April 2nd is to give the company time to prepare and deliver the dividend checks. When a stock is actively traded, the book of record of shareholders is continually changing. For convenience, TELUS names a date for which it will record every one shareholder position. This is called the dividend record date. In order to determine whether the seller or the buyer is entitled to the dividend, the company names an ex-dividend date. On and after this date, the stock sells ex-dividend, which means the seller retains the dividend and the buyer is not entitled to it. In Canada, there's a 2-day interval between the ex-date and the record date because trades settle on the third business day after a trade. Share prices will often drop after the ex-dividend date to reflect the value of the dividend. One of the eternal challenges of investing is being able to determine a good price to buy a share. Identifying a good company is usually quite easy. Determining a good price to buy it for, well, that is significantly more difficult. That wraps up our discussion on common shares. Please come back and watch upcoming segments. I'm Sean Millington.